The finance minister has in this budget tried to provide a larger, longer-term vision for the tax regime in India. So for instance, rather than trying to tick the box on DTC, he has been candid that most of what was intended to be covered by DTC is already in the Indian income tax law, and therefore has candidly admitted shelving of the DTC. On the other hand, when it comes to GST, that is really transformative from an indirect tax regime perspective, and he goes in fact full steam ahead and has an ambitious start date of April 1, 2016, which he sticks to. If we look at the budget as a whole, his whole vision for the longer term is what he tries to set out in the budget. From a direct tax regime standpoint, again, he wants to make it transformative by ensuring a phased reduction of the corporate tax rates over 4 years and a phased elimination of exemptions, incentives and deductions. The whole central theme seems to be to provide a predictable, stable, less litigious tax regime in India, which is indeed the need of the hour. It also seems to be an objective to make the tax regime simpler and far more globally competitive in terms of the tax rates in particular. The thrust of the finance minister and this government seems to be clearly in making Indian business more globally competitive and promoting ease of doing business in India, and that seems to be running through the entire budget for the current year. So for example, if we look at the deferral of the general anti-avoidance rules to 2017, a deferral by 2 years, and also ensuring that all investments made up to March 31, 2017 would be grandfathered. That indeed is a step in the right direction, because one needs to restore and bring back the level of trust and confidence between taxpayers and tax authorities before GAR can be actually allowed to go live. Similarly, in fact, when it comes to the provisions relating to indirect transfer of Indian assets, the Vodafone-like situation, the finance minister has finally come up with the much awaited clarifications, which will certainly promote ease of doing business as well as bring certainty and clarity in the tax regime. So for example, he says that only where the overseas companies' assets in India exceed or are 50% or more of the total assets of the overseas entity, the indirect transfer provisions will apply. Again, he says even when they do apply, it is only the proportionate capital gain which would be taxable. He does exempt small shareholders holding less than 5% shares from the indirect transfer taxation. He does allow exemption to overseas reorganizations of certain types, for example, foreign mergers and demergers, and so on. So all of these are positive steps in promoting simplicity and bringing clarity and certainty in the tax regime. Of course, one waits to see how the provisions relating to requirement on the Indian company to report such an indirect transfer gets finally rolled out and interpreted. One does see a sense of urgency even in other aspects to bring ease of doing business. For example, he says he will introduce rules for foreign tax credit to clarify how the procedure for giving such credit will work out. In fact, the whole objective and theme runs through the budget, not merely the tax provisions. So for example, the discussion on the e-business portal, which will integrate 14 approvals and in one source, is a great step. Similarly, his recognition of the Indian entrepreneurship, famed Indian entrepreneurship, is great in the sense that he talks of the SETU program to give tech startups an encouragement. In fact, the positivity is all through the budget. It's a budget of self-confidence. It's a budget which inculcates a sense of self-belief in India. And that's where I think even the reduction of the royalty and FTS withholding tax rate to 10% from the steep 25% is a great step. What one has to wait and see, and a little bit of concern at my end, would be the aspect of residency of companies and the concept of POEM, which, if at any time it is in India, could regard a foreign company as resident in India, and one has to see how that actually unfolds. Even from the indirect tax side, the entire addressal of the inverted duty structure, rationalizing the inverted duty structure, for instance, for tablet computers, can be a great incentive indeed for Indian business. Of course, there are certain things which I would have hoped for, like, for example, the MAT provisions which could have been rationalized, SEZ provisions which could have been rationalized, and of course some R&D incentives, particularly for the TMT space. Thank you.